All right. Welcome to Ben Franklin Venture Investment Forum's quarterly capital call meetup. I'm Jill Edwards. This is the second in our regularly quarterly meetup with angel group and organizers and early stage VCs in the Mid-Atlantic region. Today's session is being recorded. I will send you the recording link after today's session so you may listen to it later to refresh your memory or catch anything that you may have missed. As we go through today's session, please type your questions into the chat box, either during natural breaks in Doug's presentation or when he's completed the presentation. We will pose your questions to our speaker until we run up against our hour deadline. So now I'd like to introduce John Sider, Ben Franklin's Director of Second Stage Capital. He's going to moderate the discussion with our guest speaker. John, take it away.
Thanks, Jill, and thank you everybody for joining us today. We are thrilled to be having our second Ben Franklin Venture Investment capital call. We think this is something that can add a lot of value to entrepreneurs. So let's just take a second and remind everybody what the purpose of this is. So the purpose is to expose entrepreneurs in the Ben Franklin Central and Northern PA ecosystem to active early stage investors in our region, okay, with kind of all of those things. We want them to be investing now so that the information is current and up to date. We want them to be early stage because that is what is the best fit for our portfolio and our ecosystem. And we want them to be investing in this region, obviously, as part of their portfolio activity. And so we want to give you a sense of how equity investors think, what's important to them, and hopefully give you the tools you need to best prepare to seek investment and build relationships with them. So, and hopefully all of this is in an informal, non-threatening, easy access, and maybe we'll even shoot for fun environment. Let's go ahead and get started. We have a great guest with us today, Doug Patillo, who is a very experienced entrepreneur and venture capitalist, has a great background. I'm not going to go deep into his introduction. I'll let him introduce himself. But he's really one of the good guys. I've been privileged to interact with Doug really over a 10-year time frame. He is very fair. He asks tough questions of folks, but he gives feedback, he follows up, he's responsive, and he's just a really great guy, and we're so appreciative he took the time to be with us today. Let me just say, before we turn it over to Doug, let me just say one thing about format. So Doug and I will do a little Q&A here for maybe 15, 20 minutes. As your questions come up, go ahead and type them in. But then there's also going to be a dedicated time where we open it up and Jill will just be asking your questions of Doug. So I'll get things started, but then we're going to turn it over to you guys and Jill will moderate those questions into Doug. All right, so let's take it away. So Doug, I hope I didn't raise the bar too high, but why don't you go ahead and take it from here?
Yeah, thanks, John, and thanks, Jill. I think the bar was set fairly high after the first one of these that you guys did with Kathleen a few months ago. So I was yes. worried about keeping pace with that, and you went and set it higher. But thanks everyone for joining this morning. Hopefully we can make this interactive, and and you can get something out of it. I thought I would take just a couple minutes to give an overview of Leading Edge, which is the fund that I'm a part of now. Just so that you have the context for the answers I might give to the questions that you're asking. And, venture capital is a big ecosystem now. I started in this about 20 years ago, and have, this is the 7th institutional venture capital pool that I've been, a part of in managing, and each one of the funds that I've been with have had different focus areas, and the one thing to kind of keep in mind, because it's never always apparent to the entrepreneur, and that is, venture capital is an industry, which means it's competitive, and all of us are jockeying for position, just like you all are jockeying for position in your respective industries. And so we do try to maintain a sense of focus and sense of purpose. And sometimes that means the answers and advice we give are have to be consistent with that in mind. But Jill, if you have control of the slide, if you want to pop over to the first one there, I can kind of outline Leading Edge. So this was a fund that 5 of us put together back in 2014, and we started investing out of it in 2015. And it really was born out of a collective frustration for the challenges we were having in the various companies we were involved with, and in finding good funding matches for those businesses. And so we got together with a pool of high net worth individuals who are our limited partners and formed this fund. It's a small fund, but it's set up to be kind of in a classic generalist type fund. So most of us have IT, or what used to be called IT, backgrounds. We do have experience in medical devices and diagnostics. And so the types of things that we'll have interest in are going to be, not surprisingly, reflective of our collective experience. And I'll flash up what our current portfolio looks like, and you'll see that lines up. We're generally focused on companies in the Mid-Atlantic. So we've all individually built our careers here. Our network is here. And we feel if we're close by the companies that we're getting involved with, that we can really be the most helpful. The type of company that we're targeting outside of stage, outside of sector, is from a stage standpoint is early stage. That can be tough to define, and it can be pre-revenue. It can be post-revenue, but generally somewhere around that first revenue sort of level. We can do things that are very, very early. We probably won't invest in a lot of things that way, but we certainly can and want to be doing some things. And we can be opportunistic for things that are a little bit further along if if there's really a good match, if there's something that the team thinks we can add to what they're trying to figure out. Our investment size, it's a range. It's primarily limited by our fund size. So like most institutional funds, we do try to invest in successive rounds in a company. Our typical initial investment is in the couple $100,000 range. And then the expectation is, over the course of time, as the company raises successive rounds, we participate in those, and we can go up to, more or less $750,000 in any one deal before we have to start worrying about concentration issues. And so that makes us a natural syndicate partner. Most of the companies that we're investing in are seeking, $1 million to $3 million in funding, and so we position ourselves as being a part of that. And Ben Franklin is in some of the companies that we've invested in. They're a natural partner for us, as is Angels and some of the other early stage institutional funds in the area, as well as some investors that are outside the region that maybe have interest in a particular company, but to get them over the line, they want to have a local investor that can be more accessible to management when it's needed. And again, as a constraint of our fund size, if we think we're going to try and get to about 15 companies in the portfolio, that means we're trying to make between 2 and 4 new investments every year. And we look at an awful lot of deals to do it, which means that we're often in a situation where we have to pass or hold off on things that are otherwise really good opportunities, just because we have to be mindful of our pace and the overall pool size. From a structural standpoint, simple traditional fund. We've got an investment period that runs about 5 years, so we're in the middle of that. We have the usual expectation of being able to exit in a reasonable time frame. We all know how that goes, and certainly as things are going well, there's every interest in holding on until the timing's right to sell, and that's something that is unique to every business. One thing that is maybe a little unusual about our fund is that the 5 of us general partners have personally committed a substantial part of the investment in the fund. So, it's not just a matter of managing other people's money. We're making decisions because it's our money in here too, and that's important to know. So in terms of the types of businesses, within the sectors that I mentioned, and things where we have experience, we have a somewhat bias towards companies that sell stuff to other companies. We just generally have more experience with how sales teams have to be organized, how they have to be deployed, how you market, how you bring products to market in a way that can meet the tests of a business buyer. We don't have a lot of experience in companies that sell direct to consumers, although we're in one right now. So, but the other characteristics that make an attractive investment to us, you can read this stuff in a book. It's not rocket science. You got to be addressing a big enough market, because big and rapidly growing markets give you opportunities to make mistakes, and it doesn't put you in the soup. When you have experienced entrepreneurs, which doesn't mean, folks that have successfully founded and run and exited other companies. It can be people that come out of the environment that they're trying to sell into, that just have an innate, in-depth understanding of the problem they're solving and how the people they're selling to buy stuff. And that can be enough. And then, of course, anything that gives you an advantage over the incumbents, the people that have been doing this for a while, that you're going to be unseating, or people that have the same idea as you. Something that gives you an edge, because anything that gives you an edge takes some of the pressure off of having to execute flawlessly. And we all make mistakes. And so you need stuff like that. But that's none of that is unique to us. Jill, can you flip the slide, please? So a bit on us as individuals. God, those aren't the best pictures. Well, I look like the guy on the video here. I don't really look much like that guy on the black and white slide anymore. But there's five of us. The 5 of us, 2 of the 5 have the bulk of our careers managing institutional venture capital funds. So we're more or less, you could describe us as career investors. The other 3, and maybe a half if you count it, have been primarily entrepreneurs for their life. So they've started and run companies of different sorts. Rick Berkmeyer in medical diagnostics, Vance Kirshner in healthcare software, Mike Bowman in materials and chemicals, and he operates the largest incubator in Delaware. So what we try to do, what every investor tries to do, and we're no different, is to try and bring our collective experience as well as our individual experience to bear on a deal. Because if we can help you get through, get past an obstacle, then we're all better off with it. But beyond the five of us, as I mentioned at the onset, our limited partners in the fund are individuals. They're executives and successful ones in businesses all across the region, successful in their own right. And we draw upon them constantly, where they can be helpful in us vetting out an opportunity, a company's products or a market opportunity, but also a lot of them are ready, willing, and able to roll up their sleeves and get directly involved with a company. Sometimes from an investment standpoint, which is fine. It's great when that happens. Certainly from an advice standpoint, and that's something that I think really distinguishes our fund from most funds of this nature, is the ability to have that big of a team kind of in the wings. Beyond that, we really don't put any hard and fast rules on how we got to work with a company. Once the check clears, we can be on the board. We don't have to be on the board. We can be an observer on the board. However, whatever is right for the particular situation. I've personally been on about 3 dozen boards over the years, and have held every chairman position, on every committee. So, you can call on us to serve those roles, and we're happy to do it. But at the same time, if you've got a good chemistry with the group and you're getting what you need, you don't need to mix that up just for the sake of doing it. So that's kind of a general overview of what we're trying to do. The last slide that I have just gives some, and everybody can look at these on your own time. All this stuff is up on our website, leadingedgevc.com. You can see a little bit on our individual backgrounds, and certainly you can click through to these exciting companies that we've invested in at this point. But you'll see from these that they really do span a variety of industries. AppBus, which is our latest investment, is infrastructure software. Active Protective is a medical device product that targets consumers. Canceround is is a healthcare. You can probably consider that IT, but that helps targets the hospitals to help them manage their cancer patients. College Ave is a student lending company. LuxTech, component supplier to the LED lighting market. Red IQ in the residential real estate management market, and Link Labs, which is a network infrastructure company. So these businesses are located between New York and DC, and we've gotten about as far out to central Pennsylvania, and that's kind of our our general geography. So let me, I guess, pause here and see if there's anything that I've confused people with, or if we see people rapidly jumping off the line, then
Doug, I think that's a great overview. Lots of follow-up questions if you're ready for me to jump in.
Fire away.
All right, terrific. So want to get into, going back to kind of the educational objective of this. Very interested in a couple of things that you said. So 2 to 4 investments a year for Leading Edge from a pool of 350 qualified opportunities. Can you tell me a little bit about the nitty-gritty of sorting through that and what your practices are to get to those 2 to 4? And I'll just give you a little bit of context. So I heard one investor say that, John, I'm solving for no. So the first thing that I see that I come to that's a no, that gets tossed. And if I go through and in the pitch deck or whatever it is, and there's no no's, then it moves forward. And so, give me the leading edge Doug Patillo version of that.
Yeah, so that's a great question, because from the outside, I can only imagine there's just an insurmountable amount of frustration when you're trying to get access to investors, that it seems like there's a fit because we all do as good a job as we can of making our criteria vague and opaque, so you can't really tell what we're looking for. But the method behind the madness on that, and how we kind of try to filter down to things that we really are going to dig in and spend our time with because we think we can close an investment with it. There are a lot of differences between individuals. So I'll focus on kind of how I do it and how I was trained to do it, because it kind of works for me, and maybe that sheds some light on it. So there are, everybody kind of has their frameworks for what constitutes a good opportunity. And and on the subject of solving for no, I actually, there are a lot of investors that, because of just the sheer size of the pile on their desk of business plans, proverbially, they're looking for reasons to kind of kill deals. When I go through a plan, or I go through, a pitch or an executive summary, or even a 3-line descriptor on what the company does, I'm looking for the thing that sparks it. It's the reason to do the deal. No deal is perfect. No deal I've ever done is perfect. They all have flaws to them. The ones that get done are the ones that have something that's really unique and special. I mean, that could be a technical breakthrough. It could be just the sheer evidence of traction, right? That defies any no you want to give them, right? It could be, a level of expertise or whatever coming from the team. It can be anything. And so, we're in the early stage segment because we find a lot of the innovation the entrepreneurial community is doing to be exciting. And so, I'm trained to look for that thing, which is the reason to spend time with it, not the reason to pass on it. Now, that being said, you got to get through all of these plans, and you got to figure out where you're going to spend time with. And I tend to focus on market first, because I think if you've got a dynamic market, or a market that's big enough, but going through some type of change, that it's got a dynamic element to it, usually that's a scenario that's ripe for innovation, that's ripe for dislocation, that you have opportunity, right? And then of course there's the product, and does the product and the business model kind of line up well to serve that need, right? What is the source of advantage? What is the thing that's going to buy the company time in case they mess up a few times, they hit a speed bump, sales come along slower, you can't hire the people you need to. I mean, there's so many things that are going to go wrong. What is the thing that's going to still keep that opportunity valid for you, right? And not close it up. So I usually start with that stuff too. If it's a company that's post-revenue and they're selling, in some respects it's a lot easier, because you can look at who are their customers and what's the nature of that relationship, what's their business model. And if that kind of makes sense, sometimes you got to dig into it a little bit, then that's a really good indication that there's some strong momentum behind what they're doing, right? That answers a lot of it answers a lot of questions about the viability of the business. If people are buying stuff from you, and the economics of that transaction look good, you can go into, you can spend more time with it, assuming that you're going to like everything else that you hear. But there's still a long ways to go from that point. I mean, that's how you narrow down the 350 plans to a couple dozen that you're really going to have time to dig into and spend time with. And then it's it's everything. Is it a deal that makes sense, right? Does the transaction itself make sense? What's the company's financing history? How much more money is the thing going to raise? Right? Is it really a good fit for our type of fund? Can we make a kind of an impact and see our way to a return on it? We like the management, right? Where are the holes? Are the holes too big, or are they things that we can mitigate? There's 1,000 questions and 1,000 things that we need to consider. But when you get through all that stuff, you always go back to that original premise, which was, okay, so now that I found out everything I don't like about it, right? When I line that up against the things that are really that 1 or 2 or 3 reasons that are really the reasons to do the deal, how do those things balance out? And the deals that get done are the ones where you can mitigate, or you can live with the things that aren't perfect, or aren't really what you wanted to see, because the things that are there really, really define the opportunity, and you can feel good that you've got a good shot to make money on it.
That's great, Doug. That's a really insightful answer. Just seizing on something you said. So you're looking for the reason to do the deal. Doug, if you think about some of the deals that are in your portfolio or even in your history, where you were kind of the champion for the deal, can you just give us like one example of what that core looked like? Just for the purpose of having our entrepreneurs, when they're distilling their pitch, thinking about their decks and their materials, give us an example of something that really stuck with you that wasn't necessarily entrepreneur related or management related, but it was kind of a core, this is a reason to do this.
Well, now sometimes it is management. So I won't pick on these by name, but one of our, just in the leading edge portfolio, one of our companies, we came in on the ground floor because the team was probably the best team you could pull together in the world to tackle what they were doing. And you could look at this team, they knew their market, they knew the product, they had all the relationships they needed, they were coming out of the environment. It was a very easy thing to understand how others would fail at what they were trying to do. And we got behind the team, basically. And we said, we got to back you because we have supreme confidence that you are going to be successful in what you're trying to do. Even though there really wasn't a product at that point, they hadn't really sort of gone out to, and enter the market. It was like that. So those things happen. They don't happen very often, but they happen. Another one, it was the product. So it was a combination of product and market. So we had a market that was emerging, where there were a couple other participants that showed that the market was viable, and so we could look at what others were doing and the early success they were having to validate that the market dynamic was good enough. But then this company had some technical breakthroughs. And actually, we've had a couple of these where their intellectual property really gave them an opportunity to win where others would just, the science of the competition wouldn't allow them to compete well, which we thought would give us a sales advantage, a pricing advantage. And if we really messed up sales and marketing, for anybody who wanted to be a major player in that market would have to own the intellectual property that we had. So there's some meaningful blocking patents in there. So that's a good reason, to make an investment. And, it gets to the idea of, if you can put your flag on the high hill through intellectual property, and it's really solid, then you have an inherent advantage, right? You may struggle in trying to take that to market initially, but eventually, you're going to have more than your fair shot at it. We have a couple others where, you know, the thing that really made it work was the pipeline. So their post-revenue, you know, we could see how management was able to hire. So we could get confidence in their ability to operate, not just in their resume, but their ability to actually do the job. And we could talk to a bunch of customers and ask them, you know, simple questions like, hey, why'd you buy this? And hey, what's it doing for you? And is it really making a difference? And, you know, what was it like to carve out some budget for this? You know, how easy or hard was that? You know, things that will allow us to evaluate just the continued momentum, right? And so the reasons are always different. And it gets back to what I was saying earlier. So, you know, identifying what that spark, what's the number one thing a company has going for it? And is that enough? Sometimes one thing isn't enough. You got to have a couple things or a few things in there or whatever, and everything. You know, there's a couple of companies where, you know, things were all good enough, but there were a lot of risks ahead of it. But, you know, the transaction, you know, the financial aspects of the transaction were particularly attractive. So it compensated for all that stuff. It's the most frustrating thing to the entrepreneur that's having to go out and fundraise, which is it's not a checklist. It's never a checklist. It never comes down to, well, if I just show them these 2 or 3 things, I'm golden. It's a lot more art than science, and that makes it difficult to look an entrepreneur in the face when you're saying, hey, you're not quite there, or you're not even close, or hey, this just isn't a fit, right? When those entrepreneurs have committed their life to doing this, right? It's like the thing they're choosing to do to support their families, they see it, but it's got to line up well on those things for an investor.
Yeah, that makes sense. So let's talk a little bit about the financial aspect. So at the core of all this activity is a math problem, right? So there's, sort of where leading edge goes in on the valuation side and where they're hoping to exit at the end. And so let's talk a little bit about the math on that. Couple of questions. So do you, and I know the answer to this is no, but do you have a rule of thumb on, because entrepreneurs think a lot about valuation, and that's a question that often gets discussed. So when I'm going out for my first round of outside money, you know, where are the boundaries, you know? And just from an observation, this is certainly not a rule, it kind of seems like around here, the first outside money needs to come in at less than 5 million, or else you're going to get a whole lot of questions, and at a 5 million pre-money valuation, or else you're going to have a whole lot of questions from investors and the hurdle's just going to be real high. But if your offering is less than a $5 million pre-money valuation, you seem to get the benefit of the doubt and get a little bit further. That's an observation. Nobody's ever said that any kind of clear way. But what's your opinion on, you know, when somebody's raising a seed round, it's the first outside money, give us some boundaries on valuation.
Yeah. Well, that's a tough one. So from an investor standpoint, I mean, look, we're measured by what kind of returns that we provide to our limited partners. And so we're measured on our ability to buy low and sell high, right? Right. But that doesn't really help answer the question. So, you know, when I approach valuation and terms, though terms are it's the other side of the coin with valuation. And you can get a lot on valuation, you can get terms that really are going to make it tough for you, and vice versa. It's ultimately a reflection of risk and opportunity for gain, right? And so there really are no boundaries on what that initial capital can be. And I've seen money raised at just valuations that, in fact, funds that I've been with have put in, you know, have valued companies that are at initial money higher than the acquisition price of any company that I've exited. It happens. So there are no boundaries on it. It's a reflection of risk and opportunity. So everything has to be custom priced. The better you sell and the better you paint the picture of the opportunity and the better you show your plan for mitigating the risks, the better you're going to help an investor see things the way you want them seen, right? Absent of that, you can fall back on some rule of thumbs, so the investors can say, well, I can't really, that doesn't seem anything unusual about the upside, and there doesn't seem anything usual about the downside, and so I'm just going to look at the last 10 deals that I did and just think about valuation in those terms, right? So that's another point on triangulating in on this. Where possible, we do all try and look at exit valuations, good comparables, from an exit standpoint, and kind of make sure we're working backwards from that perspective to make sure that there's reasonable expectations that are being set. Because if you invest in, and it's a company in a niche software industry, but you have to exit at $10 billion to get a return, that's probably overpriced, right? You have misset expectations going in. And part of it is just the competition for other deals. If we're going to do make 2 to 4 investments in a year, we may have 5 things we love, and maybe we would actually try to get all 5 of those stuff. But some people would just look at, well, which ones are the best deals, right? And that might just come down to pricing. So your competition for pricing and terms may be somebody in a completely different business, right? That just happens to be looking for funding the way you're doing it. So it's trying to come at this from a bunch of different angles, right? What do we think the market is? What do we think, the risks and opportunities are around the plan? How much more money is the company going to need? How far can they get with this financing? And then you try to do one of these and try to arrive at something that you think is reflective. So with that in mind, no deal should get done if it isn't a fair deal, right? And that's kind of what we're going for as investors, but there's 2 sides of that. And some of the deal structures that have gotten companies and investors into trouble over the last 20 years are ones that structurally caused a misalignment between the investors and the entrepreneurs. And there's a lot of things, but the most glaring one is multiple liquidation preferences, right? That when things are going great, nobody ever dusts off the deal and say, well, I wish I got this term, or I wish I got that term, or whatever, right? There's no second thoughts. And when things are going awful, you don't really think about that stuff either. It's when you're kind of bumping along and you're facing challenges that you didn't anticipate, or the market moves on you, or some new competition comes in and things are just getting tougher. And you want to be able to work through those, but then you realize that, your investors have a different agenda than you do. That's rooted in the economics. So there's a lot of, valuations when you're buying, and buying is the easy part, right? Anybody can do a deal, right? Getting out of them down the road, that's the hard thing. But when you're thinking about the pricing and terms around a transaction, you can't just look at it as, what's right for the business now. It has to be in the context of setting the right expectations going forward, giving you enough room to make mistakes along the way and not be running counter with your investors. It's got to be a fair deal for yourself. And the investor is going to look at a bunch of different things, including comps, including the exit environment, including other deals that they're working on, and listening very intently to how the company is portraying the risk and the opportunity in order to come to deal. And a lot of deals fall apart because the entrepreneur is in a different place when it comes to valuation and terms than the investor. And those stink when those break. Deals break on terms because you like everything else.
Yep, that makes sense. Well, I hope that our Q&A here has gotten some juices flowing for our audience, and that they have questions. Let me just, one final thing before we turn it over to Jill to start pushing the questions from the audience. So Leading Edge is an early stage investor, but just to follow up on the last question. So if you think of your portfolio and what you guys have gone in at as far as pre-money valuations, can you throw out a median for roughly what you've...
No, it's all over the map. Like, it's wildly all over the map.
Okay.
And time will tell if we did something stupid in there. And that's the real upshot on all of this is, you can get a deal done and you're always just, it's top of the world when you get one done. You're just excited and everything like that. But it's 3 years or 5 years or 7 years or 15 years later when you're exiting, that's the only time if you did it right. That's the real unfairness, right? There should be some positive feedback right there to say, man, you guys got the best deal, the best deal in the world right here.
Yep. Okay, well, thanks, Doug, so much. Appreciate that time. And Jill, are you ready for us to start feeding questions to Doug?
I certainly am. The first question was, does your group have experience or investments in the enterprise resource planning or accounting software space?
Yeah. I know funds that I've been with. Let's see. We've at Leading Edge, and this is where you can, when you have a team of folks that have kind of been investing over the course of several decades. It looked beyond just the experience we're building in this particular portfolio, but just our collective individual resumes. But yeah, three of the what are now the leading accounting systems, and maybe 4 or 5 niche ERP vertical ERP platforms. Over the years, or in recent years, ERP and that scope of functionality has really blended together with CRM and some of the other core critical business information systems that companies are running on. But that's a market that that technology forces change every 10 years or so, because there's new and faster ways of doing things. You can integrate how the business workflow more easily. So that's a great market, and it's not a particularly capital intensive one too, which is good for us, being a small fund.
You had mentioned that you do business from New York down to DC, and so far you've gone as far as central Pennsylvania. Do you consider deals in Northwest Pennsylvania? Yeah,
absolutely. Absolutely. I mean, we talk about this a lot, what's our real radius should be. And our current collective wisdom is if we can be within a few hours drive of the company, then, we should be a fit for that. And the thing that's important about being in proximity, particularly with early stage, there's the old adage that early stage capital doesn't travel. Right. You got to be local to your investments, but there's a reason for that, and the reason is when you're young, when you're just getting going, you're going to have 10 times the number of almost everything you're doing. You're going to be doing for the first time, right? And you're going to want to have most want to have second opinions on things. Hey, I'm interviewing a sales guy. I think he's pretty good, but I'm just not sure. Can you drop by and interview him and see what you think? Well, you can do that if it's a 2-hour drive, right? You can just jump in the car. I'll be up there this afternoon, right? If you have to get on a plane and go across country or whatever, or it's really far drive, then you can't do it, or you're doing it by phone or you're doing it over, which isn't ideal, right? You want to be close so that you can be active. The other thing too, which I alluded to earlier, is our networks are here. They're concentrated here. And so our ability to refer employee candidates, usually the teams that we're investing in, they're usually incomplete. You're adding 1 or 2 senior level people every year for the next few years. And you don't just want to be sifting through resumes for those. You want to tap into networks, people that have seen these folks work in that function, in that job, in that industry, and that comes with a qualified reference. And so we're more likely to do that if we're nearby the company. When you think of all the service providers that you're going to have as you're building your company, banks, lawyers, accountants, all that stuff, you want to tap into other people's networks. And so our ability to do all that stuff gets a lot harder if we're outside our region because we just don't know people.
Okay, thanks. The next question, how much capital is available to apply in the current fund?
A lot. So part of it's another challenge that most people don't care about, but we care about it a lot. And operating a fund is...
Before you go any further, can you kind of scooch further to the right? We're losing your picture.
All right. How's that? I was drifting? Yeah. I do that when the questions get tougher. I just sort of move towards the back. One of the management challenges you have when you're operating in a fund is how you budget for follow-ons in companies. And so there's a kind of a rule of thumb, that we'll use, that you want to kind of keep 2 or 3 times your initial investment available in case the company needs to come back. And companies come back for all sorts of reasons. Some of them, they come back for good reasons. Hey, things are great. We need more gas in the tank and we don't want to go out to market, whatever, or to participate on a financing if new investors are coming in. That's a good sign of faith in the business, right? When the insiders are coming back in. Sometimes, you hit a speed bump. Things are great, but you're going to be short on cash, and you need your investors to be able to support you on that. And we want to be able to do that. Whatever. There's all kinds of reasons. And so, but they're not required. They're not committed. You don't have to come back for a second round. And so one of the challenges we have in operating a fund are, the 7 portfolio companies we have, and it'd be 8, who's going to come back? Who's going to do another round? And, what makes it worse in these days, it used to be when I was starting out in venture capital, you needed $30 million to build a software company. And so, you could basically stage out when your follow-ons would be, and you knew when the company was going to run out of money because they had to build their own data center and they had to hire their entire development teams and they had to be, pulling people out of, Fortune 500 companies to manage things. And, it was tough. You don't need any of that stuff now. Companies are much leaner. They're much more nimble. The development frameworks and workflows and are designed for speed and for capital efficiency. So we're looking at some of our companies and saying, well, none of these guys may come back for a follow-on. And so what are we going to do with all this other capital? So it becomes a big, I don't know what's going to happen. So we've got, maybe a third or so of the fund that is either invested or we really feel is sort of earmarked for a follow-on that's coming. We've got another slug of it that we sort of want to be able to direct to these portfolio companies that we have, but it may never happen. We don't know. And then, we've got the rest, which, hopefully going for new deals. And so that's why that 15 company target for the portfolio, that could very well end up being 10, or it could be 25.
Okay, thanks.
It's really hard to know.
And another question that was, I think, kind of related to a question that John had asked you earlier. What is the typical range of valuation at which you invest? Pre-money at $1 million to $2 million, or 5 to 10, or whatever?
Somewhere between 1 and 100 million. I think somebody went on mute. Did you go on mute? Did you
I did. I just said, can you be a little more vague? But no,
yeah,
I get it.
I'm not. Well, I am trying to be evasive on that. But because every situation is unique. It's every unique. Most of the stuff we're going to do is going to be like what John was saying, under 5 million pre, but that's because that's what most of the opportunities are seeking. That's what's coming together for them. But that doesn't mean we will say no to something just because it has a higher price. It all has to do with what the opportunity is and what kind of progress the business has made. It's risk and opportunity, and can we make a par return on it?
Okay. Not a question, but a comment from one of our attendees. Not a question. Really like Doug's plain truth talk. We need more investors of his ilk. Thanks for participating.
Oh, we're all over the place. No. The approach that I'm talking about is not unique to me. You get a similar thing. I mean, collectively, we may not all describe it this way, but look, anybody who's doing early stage investing, who's been doing it for a little while, right? So you can separate the folks that are just looking to stay busy, right? They're doing it because they're really excited about working with these teams that are trailblazing, new roads, that are doing very exciting things, coming up with breakthroughs, whether it's a science breakthrough or they just recognize a problem that nobody else recognized or figure out a solution that nobody else figured out. And they're running with it and they're committing their lives to it. And that's pretty exciting. So our job as investors to represent our shareholders is try to turn that into something where we can participate in the success of that business financially and help, provide the resources that those entrepreneurs need to be successful.
Okay.
There are a couple questions that are coming up on the chat. I don't know if I should.
Yeah. And this question came up both in the chat and in the Q&A. If somebody in our audience wanted to contact you to have a conversation, how do they do that?
Just reach out. We're very approachable. You can go direct to us. Our contact information is on our website. We try very hard to be very responsive because we know you're putting in the work to get your business going, and it's and we want to signal to you we're going to be there for you, right? And so email works great for that. Referrals are also really good. So if you're unsure what to say or how to position something or whatever, talk to your advisors and talk to your lawyers. Most folks have a friend or a lawyer or a business acquaintance or whatever, an accountant, and ask them to say, who should I talk to? And hopefully they'll recommend us or any of the folks in the community. One of the things, so just as a secondary point to that, a lot of people are hesitant to reach out if they don't have their story straight and they don't feel like they have all their ducks lined up. Again, I've yet to find the perfect opportunity. and I don't think I ever will, and that's okay. So that's the point is, you can have, it is fair game, and I certainly encourage it to have preliminary conversations. Hey, I got this crazy idea, and I'm thinking about pursuing it. You know, tell me I'm wrong, or what are the things that I should be at least filling in? You know, what blanks need to get filled in now before I can really expect to get serious investment consideration from someone, you know, you or anyone else. That's fine. You know, you don't have to have all the answers, right? If you're talking to me, I would probably quiz you on, well, why are you doing that? Right? What is it that's making this seem so attractive to you that you want to stop a well-paying job and go do this, and deal with the slog of being an entrepreneur for the next 15 years? You know, what are you seeing that the rest of the world isn't? And, you know, if you got a good answer to that, usually the rest of the stuff you can kind of figure out. You know, there isn't a lot of invention required on how you go to market or how you build a product and that kind of thing. It's really more where the kernel of the idea is coming from. So just reach out.
Okay, thanks. Tell us about the top 3 red flags that when you see them, you're just, you know, ready to run for the hills.
Geez, I don't know. Well, it could be it's a long, and it's unfortunately a growing list, right? I mean, that's the ugly side of experience, right? The ugly side of experience is that, you know, you kind of accumulate a ever-growing list and long list of things that can go wrong with a deal, right? So they run the gambit. They really run the gambit. If it's not a well-formed idea, you know, if it's management that just doesn't seem like they know anything about the problem they're trying to solve, right? Or if they really haven't thought through enough just how they're going to sell something or how they're going to build something or what really makes it different, you know, in a sustainable way. You know, if it's those things can be turnoffs. Deal terms, if they're offered too early, you know, before you really understand what the opportunity is, that can be a turnoff. Unfortunately, that can be the wrong turnoff, right? You can miss good opportunities because of, you know, it's pitched on terms too early, you know, instead of really what's going to make the thing, why this some company is so attractive. You know, a lot other things that usually come up in due diligence. If what we hear from talking to customers or from the independent work that we're doing doesn't match what we're hearing from management, then that's a deal killer. Those suck because, you know, you've gotten to the point where you're really spending a lot of time with them, and sometimes, you know, it's a absolute killer. More often than not, it's a more of a pause where you say, okay, well, wait a minute, this doesn't look like it's really ready to accomplish the things that they're ready to accomplish, or they're not raising enough money to do the things that they're going to have to do in the short term, or they have a gap here on the team that we didn't think was a gap at start, or, you know what, this is going to be a much harder product to bring to market than we thought it was, stuff like that. It's more diligent stuff that kind of comes out that maybe, you know, tarnishes the initial enthusiasm. So sometimes you can get through those, and you just, right, you get through the valley of despair and you get right back up on your horse and you plow ahead and you get the deal done. And those are great. And you know what? That happens to some extent on every single investment, right? You always start, everything's bright and shiny after when you get going on due diligence, and then you learn some things kind of along the way that tarnishes the opinion a little bit, and then it's a matter of can you get through, can you overcome those or not. Sometimes they're enough where you have to put it to the side and say, okay, well, you can do X, Y, and Z, but let's revisit this in a quarter or two or 3 quarters. And if you've kind of shown progress on that, then, hey, we're right back in here and we're enthused. And that happens quite a bit. Sometimes it's there's something that comes up which is just a deal killer. And the deal killers usually relate to, is something, a transparency issue or something that we didn't, that really ran counter to what we were expecting to see in a major way, or whatever. Maybe the IP is no good, or something else that was like a foundation reason to do the deal is no longer valid. Those end up, but it could be anything. It could come from anywhere in the business. It could be from team, market, or competition, or IP, or product, or whatever. You could have a bunch of customers and you lose a couple of them, like right away. It could just be a flag that makes you have to stop at that point. But
okay,
the entrepreneur should want to stop. But here's the other side of that, and I got to make this one point. If we're coming together on a deal in the right way with the entrepreneur, right? If we're really aligned and we're really looking at the opportunity the same way and the risks at the same way, which is the goal that we should all be aspiring to, then if something like that happens, the entrepreneur should be fine with it, right? They should see that the risk trade-off is imbalanced, and they would want to put it on hold for all the exact same reasons.
Okay.
Does that make sense?
Yeah. Okay. We have reached the end of our hour. So Doug and John, if either of you have any last thoughts, we'd love to have them on. And then otherwise, for our audience, we thank you very much for your time and your attention. As Doug mentioned, he's more than happy to contact you if you to talk with you, or email you if you reach out to him. So gentlemen, any last thoughts before we close out the session?
I'll just say, and thanks for everyone for listening in and lobbing in some questions. Be right there. This is a great time to start a business. It seems like there's more capital available in our region than there has been in 15 years. May not always seem apparent, but I think it's out there. There's, it's never been easy. It's never been easier. Never been easier in my entire investing career to start a business and enter a market. You need less capital to do it than at any point in history. It's easier than it's ever been to find qualified people to jump in alongside you. You can form companies easier than ever. You can get out to market without giving up big chunks of your company. And that's a great environment to be in. You still have all the execution risks. That's never changed. That's as hard as it's ever been. But at least you can get going. And you can get going with some friendly people that can be right in there with you and support you. So with that, from my perspective, reach out with any questions. I'm around. I'm in the market. I'd be happy to hear about what you're working on.
Great, Doug. Thanks. John, anything from you?
Yeah, I just want to thank Doug for your time. We don't take it for granted that you set aside an hour for us, and I think this has been really educational, and really glad people had the chance to see the Doug Patillo that we all know and love. So thanks for your participation, and thanks to the audience for tuning in. We'll have another one. We'll have these every quarter. So we'll have another one targeting some really good investors. So join us for that. Stay tuned for the email talking about it.
Great. Thank you.
All right. Thank you all very much. And we will, I'll be sending the recording link out to you later in the day. Thanks so much.